I think I first want to say like how I was introduced to the capital markets before diving into the momentum division. I would say that first of all, I think there is a movement in the last few years that a lot of young people started trading and being in the capital markets and trying to understand what is a stock, what is a bond, how does mortgages work, what is going on with the real estate market. Even before we're speaking about stocks and momentum trading specifically, I was introduced to this to the capital markets a few years ago by a good friend of my brother that told me, "Hey, Yuval, I think it is a great area to be in. You can work in sales in the finance industry, and then you can be promoted and maybe manage other people money if you have the licenses and you know what you're doing and all of that." And I started in sales. I didn't really like the sales vision of the finance, but I really like thinking about investing and how can I make the amount of money I have bigger, and how can I beat inflation, because we're always going to the supermarket or you want to buy a house, and a lot of the time when you wait the price goes higher and higher, and much faster than a lot of the time what our income is, and like the income growth is much slower than assets growth on average. And then I really enjoyed like looking at stocks and trying to understand like which areas have the biggest potential. Like when you're speaking about bonds or forex, of course you can be very leveraged and you can do really high returns in bonds and forex and everything. In the capital markets, you can do a ton of money and have like very high performance in percentage terms, in absolute money terms. But I felt like stocks are moving much faster, much faster. The volatility there is very high. You don't need to be leveraged at all. Like if you are with the right stocks, you can be 20% invested and beat the S&P 500 by a big margin. If we're speaking about momentum trading, and of course, ideally you want to be in a good periods, not 20% invested, and maybe sometimes if you know really good how to manage the risk, maybe be also in a margin. But I felt like this area has a lot of potential and has a lot of it broke my imagine like really high when you see how stocks move, and stocks that skyrocket from 2 to 40 in 1.5 year. And it's something that really catch my eye and really catch my attention. And first of all, I got to it when I heard about the book How to Make Money in Stocks by William O'Neill. William was like the Warren Buffett of the growth investing. He's like one of the best in this area. He died like 2 years ago at the age of about 90. Um, and I'll explain a little bit about growth investing, and then it will be easier to understand the momentum trading itself. A growth investing targets companies expected to expand their revenue and earnings at an above average rate, prioritizing massive future potential over current valuation. These businesses typically reinvest all their profits back into expansion and R&D rather than paying dividends, aiming for maximum capital appreciation. And this is like very different from value investing, which a lot of people are interested in, and I'm not. Like the Warren Buffett, he's like the Oracle of Omaha, he's like the king of the value investing. This like more investing that focused on identifying companies trading less than their actual intrinsic worth, especially hunting for market bargains. Investors really rely on deep fundamental analysis of financial metrics, betting that the market will eventually recognize the company's true value and drive the stock price up. So I'm more in the growth investing, what I said earlier. I'm looking for stocks that are within bottlenecks of the market, within story stocks. Suddenly, it was like 1 year and 2 years ago, everyone talked about nuclear energy. Will nuclear energy be the next thing? As a momentum trader, I don't know. But I don't need to know the exact story or what will happen, because nobody knows what will happen. And this is like, I will tell about it more later, but nobody knows what will happen. But when people have their imagination really high about something and really want to own something, and especially if it's not like a huge stock, it can drive price really, really high, even without earnings, without sales, only on the story. We have a lot of examples of the last huge movement in the market that is also right now in the market since like the end of March, where you have a lot of bottlenecks. It's the photonics area, the memory chips area. Some of them do have like a very high growth rate in revenues and in earnings, and we will dive to that deep later also. But I'm looking at fundamentals of stocks. I'm looking at story stocks. Story stocks can be quantum computing. It can be nuclear energy. Um, it can be drones name that doesn't really have huge sales. Um, and that's how I view the markets in teams, and to try to find the leaders within the markets, which really focus on the fundamentals too. And I'm combining the graph of the stock to see where can I enter with low risk, and also to get the footprints. Sometimes we have footprints on the graph to see which tend to be more like a market leaders. By saying market leaders, I mean the stocks which I like this definition. Market leaders are the stocks that go up the most. Yeah, this is a really great question, and I thought that maybe you will ask me that, and a lot of people ask me that, and I have a very specific answer to that question, which relates to something I said 2 minutes ago. I don't know if there is an AI bubble. And you think to yourself, okay, so why are you listening to this podcast? This guy says nobody knows what will be in the future, doesn't know if there will be an AI bubble. What's interesting? What does he know? And I think how I view the markets is don't predict, react. I also did a meme on that with Ray. Like it is a very popular theme that I changed something in the photo there. What I like to do is to manage the risk on the stocks that I want to buy, because nobody really knows what will happen. We have only clues and footprints on what happened in the past and what is more probable or what is less probable that will happen. And if there is an AI bubble, I don't know. I think that like in every market's cycle, there are stocks that are bubbles. If you go out in history, you will see every year, every few years, there are stocks that aren't going back to their price, or if they go back to their price, it takes a lot of years to come back to that price. So if I think there is a bubble, for sure, with all the more than 10,000 stocks that are traded in the US, which I trade mostly in the US, probably there is one stock or more that there are bubbles, because if the stock will go up 70% in a year, it was a bubble. So there are stocks and some AI stocks that I guess that they are bubbles, but you can never know if there is a bubble only in hindsight. And because we can't have hindsight on the future, what we do is work with what we can't do, and this is like goes like the sentence: don't predict, react. Meaning that if I see a lot of stocks going down, breaking important levels, you see a lot of panic in the markets, you see a lot of trades that doesn't work, so I back up. I don't push the gas when the market environment goes against me. And even if there is an AI bubble, if I buy a stock, let's say at $50, and it goes to $300, and I sell some of it or all of it, I don't care if afterwards it go to $10. So I don't view stocks as bubbly or not. Like I want to enter when there is a stage that the stock goes high a lot, the higher the better, the faster the better. And this is where comes the momentum trading, which is different than like regular technical trading, if you can say like this. I'm not looking for taking a 10% profit from a stock that I will buy, it go up 10% in a month, I will sell. I'm not looking at stuff like that. I'm looking to find the next market leaders, the outliers of the market. And this is another thing you need to take into the consideration when you're entering the momentum trading, is that a lot of the time you will buy bubbles and you will buy very expensive stocks that a lot of people that dive into the fundamentals would say sometimes there's nothing in it, sometimes it's very pricey, and sometimes it becomes less expensive in time because the revenue and earnings making the stock cheaper. But I'm not waiting for the stock to be cheap, and that I think something that is differentiating between value investing and growth investing. Yeah, so it's not a ATR stock. What maybe you're speaking about? It's stocks with high ATR. First of all, I'll explain what ATR is. ATR is average true range, meaning how much the stocks moved on average in the last. You need to take a period, but I'm using a lot 14 days. You can take the 20 days. It doesn't really matter. And to see how much a stocks moved on average in percentage terms, it is including gaps that there are a lot of in these days, and that I can see if the stocks is a fast moving name or is it a slow moving name. Of course, that is something that always changing, because if a stock was not volatile and become really volatile months after, it will not have the same ATR. It's always moving. But I'm looking for stocks with ATR of minimum 3%. This is like the minimum, and also I prefer the stocks to be 5% and higher. In the ATR, I don't really like to trade like really crazy ATR, like 20% and above. I think it's crazy because it's very, very hard to manage risk. And I don't want to put a 10% stop loss. So I really like this 5% area, 6, 7, 8. And why do I like stocks like this? Because if a stock is going to move, let's say, exponentially in relative to what it did before, which stocks will go higher probably? The one with the 6% ATR or the one with 1.5 ATR or one in a 1.5% ATR? If you will look like stocks that have 2.5% ATR that went like really parabolic in relative to these stocks, you will measure how much it went up. So you'll see it went up 30%, 40%, 50%. It's like very parabolic for a stock with the 2% average ATR. But if you look at stocks that have 7% ATR, sometimes 300% move, it's not something that will say, wow, it went up really much when you look on the graph. So I want to have to be in the probability where like more great opportunities should emerge. Of course, that if you will take a stock with 2.5 ATR, the one that went up the most the whole year, it probably went up a really nice. It probably did a really nice move. But if you will compare it to a stock with 7% ATR and look at a stock like this that had a huge move, it went up much higher, much faster. So I'm like using like 3% average ATR. Like this is like the minimum threshold, but a lot of the time the threshold for me is more like 4 or 5%. There are a lot of 5%, 6%, 7% stock with ATR. You also see that a lot of the story stocks have higher ATR, like it goes together. And the market leaders, the one with the really huge earnings beats and something like that, if you look this period like at Micron or SanDisk or AOI or AXT or stuff like that, they don't have 3% ATR. I think it's the combination between the potential of the stock that I look at higher ATR, and also because that's how these stocks move. They don't have 2% ATR moves. So first of all, I'm looking at it as a scanning process and to which stocks to look at, because there are more than 10,000 stocks, like I said earlier, in the US only, and I cannot track 2,000%, not percent, sorry, 2,000 stocks. You cannot track daily and understand what's going on there, know their fundamentals, understand their market mechanics, which stocks are similar to them. Like, you cannot know that when you're tracking so many names. So you want to track enough names that you will have more probabilities of finding the next market leaders, but there is like maximum names that you can track, because after that you will not know to what enter to. If you track even 500 names, it's very hard to choose from which one to goes in, and you need to choose, because you can have 500 stocks like there is in the S&P 500, but in trading, if you have 500 stocks, how you can manage them? Yeah, so pullback, it's when a stock like goes up and then going down, but it's not eliminating the whole move, because then it's more than a pullback. It's like change the stock characteristics and change its uptrend. If it like stock go from uptrend to downtrend, I don't call it a pullback. But if a stock, let's say, I'll give an example, it will be easier, went up from 100% to 200%, and then it goes to 100, not percent, sorry, in dollar terms. If it was a $100 stock and went to $200 stock, and then it pulled back to $170 stocks, this is a pullback. Yeah, so what I'm looking at, first of all, like pullbacks are really good when you know on which stocks to be, because there are a lot of, it's like on everything in the market. A lot of stocks will go up, a lot of stocks will go down. This is how the market works. But they need to know which one to track, which one to trying to trade, that will have a better probability of really finding a next big move. And what I like in pullbacks, that if they pull back like to a former support that held before, or they're coming to moving averages that I like, the 50-day moving average, the 21 exponential moving average, the 10 exponential moving average. I more like the 50 SMA and the 21 EMA, but there I'm looking for stocks that come into this moving average and they go up from that, and then I'm buying the strengths after the weakness. And on which pullbacks to look, I think it's come to consideration first on which stocks to track, because it's not the pullback that making the huge move after the pullback, it's the stock itself and the story and the fundamentals and the market environment and the theme of the stock and news that will happen after the pullback ends. But in a pullback manner, I'm looking for stocks that doesn't pull back a ton amount, that investor didn't give up on the stock. Like if the market has a pullback, I'm looking for stock that pull back right away. And sometimes when the market is having a higher low in a pullback, a lower low in a pullback, I want the stock to have a higher low. So then it's showing relative strengths. It's showing the stock is much stronger than the overall market, and in potential it will go a lot when the market gets back to the uptrend. Yeah, so setup, first of all, it's like the word itself, is when you have like an environment or a specific situation where you can work on. And when you look at a lot of stocks, you see that there are a lot of commonalities between stocks. When I'm talking about setup, it's more like the technical way, like when I put my stop, if I should enter. And these I divide them to 4 different setups. The first of all is breakout. What is a breakout? A breakout is when a stock, I'm looking for, first of all, no, I will say it different. First of all, I'm looking in the breakout setup, I'm looking for initial burst. What does it mean? Before the stock broke out of something, of an area, let's say the stock was trading between $20 to $50. Okay, and it's moving on and on, sometimes more close to the 50-day, not 50 day, $50, sometimes more to $20. And I'm looking to see that before it went to this consolidation mode, it had a huge run or something like this, like it had already power within it, the momentum characteristics of stocks that is strong that it was before. And then I'm looking for the stock to consolidating. Momentum trading is first of all the game of the change between expansion and contraction, because this is how the law of supply and demand works. Most setups rely on period of tightening price action. It can be cup and handles, bull flags, flat bases. Tightness proves that selling pressure has dried up probably. Sometimes expansions require a fundamental sparks, like I said. It can be earnings and sales or episodic pivot, which is another setup that we'll discuss about. It can be a macro shifting news, earnings gaps. It can be a clinical trial data, FDA. It can be nowadays Trump taking a stake in a company, like we saw in the quantum computing names and in the drone names, and we saw what happened to them a few days after. And what I'm looking at is that the stock will be tight for some times and it will break up of the tightness, meaning that investors are willing to pay higher prices for the stock. And that I think something that is really defining momentum trading is that you need to be in stock that have momentum. You need to be in stocks that are moving. Like I will not buy a stock just because it went down a lot and maybe now it's cheap, because this is not my style. It can be a great style for someone else, and maybe there are people that will do great performance, do ton of money, feel much better to buy stocks when are in downtrending, and because they understand the business so much that they know something the market doesn't know. But I'm not in that area. I'm more in the momentum area, which stock has a power, it's consolidating, it's basing with a different price structure, and then it goes up from that consolidation. Because I'm using stop losses and I'm managing risk, typically I'm not randomly buying inside the base. I can buy a lot of time inside the base, and I'm not always looking to buy at the end of the base when the price officially broke out of the entire base, because a lot of the times these days you have a lot of volatility in those areas. And sometimes the stock goes up, do a fake out, then goes down back, shake out people, and goes up again. So I'm buying sometimes inside the base, but I need to see like something like a VCP, like a volatility contraction, something that the price, like there is some agreement between sellers and buyers, and to see this agreement went to the upside, and then I'm buying on this break of that. It can be, like I said, VCP, volatility contraction pattern from Mark Minervini. It can be an inside day, which means like the stock had a big day before. It's a little bit consolidating after this day, a little bit pulling back, and then taking those day high. It can be like a few days where the stock didn't move a lot and breaking out of that. It can be pulling back to a moving average, consolidating for 1, 2, 3 days and go after that again. Or it can be sometimes I do at the breakout of a base, like I did in Micron this year. I bought Micron, it was the day. I bought Micron on the 22nd of April when it broke out above the high of March 18 base. So sometimes I do buy the high of the base, but it was consolidating for a few days. It was near the 10 EMA. I don't like to buy just stretch if it goes up above that. Yeah, first of all, I would say that there is some correlation between the different kind of setups, and a lot of the time it is the combination of a few. Like stock can break out, like I said earlier, it can break out to new highs because of an episodic pivot. And you can say the setup itself is a combination between episodic pivots and breakouts. Sometimes there is an episodic pivot, but it doesn't break the all-time high or a base high. It really depends. And sometimes the combination between the different setups brings you a really nice opportunities. Yeah, I will speak about what is the episodic pivots. First of all, like the name says, yeah, I'm speaking about the episodic pivot. Breakout is when a stock is taking off from a kind of area. It can be a few days, it can be a big base, it can be pulling back to the moving average and then break out the highs of a few days consolidation. Breakout is more in the area of the price structure, meaning that what's if a stock, let's say a stock was $2, okay, and it went up to $100, probably will not do it in one day. Let's say it took it 2 years. Okay, so it will start at $2, it'll go up to 3, pull back to 2.7. It will then go to 5, pull back to 4. It will suddenly has the momentum, it go first to $10, then it pull back to 8.5. These are the law of supply and demand. And those pullbacks and consolidations create bases of a stock. And a breakout is sometimes the breakout of the whole base, like the example I gave with the $20 stock and $50 stock that is moving between 20 and 50, and suddenly it breaks the $50 to the upside, meaning investors and speculators and traders are willing to pay higher for the stock. And sometimes a breakout can be inside the base, because the stock moved from $20 to $50. Maybe in the 40-ish area, there will be a little bit of handle, like a few days consolidating, and it will break out 42. So this, I call it breakout 2. This breakout. Episodic pivot, sometimes these stocks have like two setups together, because a stock can break out to new all-time high because of an episodic pivot. And what I said, that sometimes the combination between the two setups create really nice opportunities. So I'll say what is episodic pivot. Like the name suggests, episodic pivot is first of all something that changed materially in the company. It can be earnings. Let's say the stock was trading at $40. Okay. And a lot of value investors and funds look at it, wow, it's overpriced, the price to sale is high, the price to earnings is high, the growth doesn't is not enough for this price and sales and price to earnings, and they're not selling anything new, and we don't know how they're going to make a lot of money that will compensate investors for buying this price of a stock. And then the stock have earnings, and instead, let's say, of having a revenue of $1 billion, it suddenly has $1.8 billion in revenue. Something that materially changed. The company says we have a huge backlog, much before they thought. They are guiding, instead of 20 cents per share EPS, earnings per share, they are guiding 50% EPS per share. So now all the analysts and pension funds and hedge funds need to go back to their DCF, discounted cash flow. For the one who doesn't know, this is you putting a lot of numbers in the Excel, trying to understand how much will be the sales, how much will be the revenues. You're taking their the interest rates of the Federal Reserve Bank, and you took into consideration a different kind of stuff, and then you have like the price target or how much the stock valued, and then they go to their models and say, okay, we need to change. The revenues are not what we thought. The earnings are not what we thought. And a stock that was priced $40 a share and was expensive to them, maybe will jump overnight to $70 per share, and now it will be cheap after it went up 75% overnight. And this is like something that is really material change. It can be also in biotech area. I know Christian Flanders, a guy that was in the USIC, US Investing Championship. He was in the competition. He finished like very high in the rankings in 2024, 2025. He took an episodic pivot setup in 2025 about a stock called ABVX. These stocks, like they reported something about a clinical trial that it was much more safe and much more effective than they thought, and there was something different there. And the stock went up from $10 to more than $60 in one night. And then the stock, this is where he did money on, went up from $60 to 150, 148 very quick from there. So we're speaking here at stuff that change materially how investors look at the company. It can be new products, it can be the guidance, it can be an FDA approval, it can be, like I said, Trump taking a stake in the company. We looked what happened. Let's see what's going on today. They took a position in unusual machines. So I'm seeing now that today it goes up a little bit down, but it went up from 80.5% to 29.5%, not percent in dollar terms. It was $18.5. It went up to $30, more than $20 intraday in one day. It can be the quantum computing thing. Let's say QBTS. It closed on $90 and went up to more than $30 in 2 days. We can look in Fastly, which has a news about the agentic AI, and it went up overnight from $9. The high of the day a day after was $17. And then you say, okay, if it's already gapped up, how can the stock work out more? Like there was already the change, and then you see it a lot of the time there are an an initial reaction that is really, really high, and the overall reaction after that, the stock can go up parabolically and really fast after that also. Sometimes it goes straight up after the first day. Sometimes it takes a few days consolidating after the huge move and then go up higher. Sometimes the market can be not that strong, it will fade, and a few weeks or few months after it will go straight up again. We have here the thing that is called the highest volume edge, highest volume ever, or highest volume in 1 year, or highest volume since IPO. We see a lot of the stocks that have episodic pivots have the highest volume ever, meaning that a lot of traders, a lot of investors, a lot of funds, it depends which stock. If the stock is really small, maybe it's not that much of a market participants, but if the stock is big, it can involve a lot of market participants that just change how they view the stock and how they view the company. And this can lead a lot of the times to a really fast and high velocity moves with a lot of percentage. You can look historically on that kind of stuff. Sometimes it is something very quick. Sometimes it's something that takes a little bit time to consolidate. Um, yeah, and stuff like that. So I think it is a really good question, and I think it is depends on the market environment, and not every time like it really affects. But when Trump says stuff, usually it affects a lot. I don't know if to say more than 50% of the time, because then I need to check to see every stock that talked about and see what was the performance. But sometimes when Trump says something about a stock, it skyrockets after that. We're seeing today Dell going up more than 30% because of a really, really strong earnings. They beat earnings by 64%, and the revenue they beat by more than 22%. And Trump has effects on the markets. I think it's not only in a specific stock, but also on the overall markets. When he says stuff about Iran, when he says stuff about the tariffs, it was last year, he moves the market a lot. But here comes a hard but important part, is that you need to do your own process. And you can trust yourself. Like it's okay that if Trump said something, you can look at it and maybe it gives it a higher potential. And he does move the market. That's for sure. We saw it in the 1.5 year, and he moved the markets a lot. And a lot of the time he does operations in the weekend because the market is closed. And I think he looks at the market a lot, in my personal view, and he does move stocks. Um, but you need to do your own process and to understand when to enter stocks, not because Trump said. Because it's not that Trump gives you an entry price, when to sell the stock, and manage your risk and which position size. You need to have your own process and to understand to come into a stock, maybe because Trump opened a stake too, like happened in Intel or happened in some other names that we don't have a lot of time after he did it to see what are the results. You can like says, okay, because he took a stake, I will look at it much more, or try to build a small position, or I will dig deep dive more on the industry and stuff like that. But I don't think that you can trust anyone, only yourself, when it comes to trading. It's okay to follow a lot of people. I also there are people that I think you should follow. I have specific names if you would want me to say. But I think you should first of all understand markets by yourself, how to manage risk, how the markets move, because there is a lot of randomness in the markets. Nobody knows what the S&P 500 going to do. Even Trump, I think, doesn't know. Maybe if you really try hard, he can change the markets from green to red or red to green. But I think he can theoretically. But the average person and all of us, we do not know what is going to be the direction of the markets. We only can see what happened, and from that, taking this data and understand what will we do or why we're doing that stuff, or what should happen, or it's not what should, but what is more probable. And then you are less surprised about markets. Because let's say if you know that your system, in your trading system, you're right 30% of the times, there will be a lot of times where you will have 10 trades in a row when you're losing in those trades. And if you're trading stocks that barely move, you need to don't be surprised that the stock doesn't skyrocket. And you need to understand how stocks move in a correction, and how stocks move in different market environment. The environment we are in right now, on the environment we were in 2020, 2021 after the COVID crash, or the environment of 98 and 99 are not the same environment as 2011, are not the same environment of 2020, are not the same environment as 2000. And when you have more knowledge and you did the exercise, you look at how stocks moved, you look at different times when stocks moved, you understand what is those episodic pivots, like what really drives stocks up, why this stock has a lot of earnings growth and revenue and went up, and why another stock that has earnings growth and revenue didn't went up. And to understand the market's mechanics and how price structure works and how the teams works and different kind of setups. And nothing in life, it's not only in trading or in the capital markets, nothing in life is guaranteed. But you do need to take actions in life. You do need to take decisions. You do need to understand when you should enter stocks and when you should not. And there's not 100% answer to that. But if you studied enough and went through a lot of stocks, how did they move, and manage the risk, and you have you're listening to yourself, and you understand that when you have a stop loss, you have a stop loss, and you're going out, no question asked, and you know that sometimes you need to re-enter a stock, and you know in which team is it going on, and you know some of the risks that they have potential, and you see some of the risks in other stocks materialize before, then you can act better for yourself, because Trump will not be probably the president of the United States in the next 20 years. I don't think it is every major world leader. I think Trump is more involved, much higher than most of US presidents. I didn't do research on that, but from what I saw in Biden and what I saw with other presidents, I think he's much more involved because he's a businessman. He wants to bring a lot of industry to America. He really cares, I think, about the interest rates, about the mortgage rates. He wants the U.S. to continue to be the leading country in the world, and I think it is really bothering him what's going on in markets. And we're seeing that a lot of time that the market goes down, uh, he helps to lift it up. And I don't know how much will it stay like that? But what was in the last 1.5 years, that even if the market crashed, he lifted afterwards. I don't think it is not only his role, not that he is the only one who is involving in the markets. Like if he was saying something and the markets wouldn't move, they wouldn't move. And there, I can say like in this environment, the movement is because a lot of people are really trusting this AI movement, and a lot of people look at the fundamentals, and a lot of companies gives a really strong earnings reports, and it's not just Trump. This like huge move in semis, in photonics, in memory stocks, in some cloud stocks, in the neo cloud stocks. Like it's not all connected to Trump. I don't think that he talked about each company that went up a lot. So there are a lot of there are a lot of environment things that happened, a lot of earnings, a lot of investor sentiments. Investor sentiment is something that is very, very important in markets. Some market participants, uh, like let's say like I'm when the environment is much more greedy and much more stocks are going up, this is the environment that I press the gas more. Um, so it's also it's always like the old saying goes, price change before sentiment. So a lot of people, maybe some people will be a bearish on the stocks or doesn't believe the story or doesn't believe what's going on in the markets, and the market's always climbing on a wall of worry. Because if everyone is not worried and everyone is already inside, there's no one that will buy the market anymore. And these are the times usually when major change in the market character is going on. A lot of pullbacks in the markets and corrections are not in those extremes. But when nobody is left to buy, then the market usually tops. Um, and I'm not trying to predict something. Like I look at it every day, and I can change my thinking 3 times a day, and I'm not looking like on macro effects. Like I'm not looking, okay, the interest rates are high, then stocks should go down, and what will be with inflation. I did it in the past, and I feel like what is working more for me is more looking at the overall environment, overall what is going at the stocks, to look at the charts, to look at the earnings, to look at the teams, to understand the market mechanics and what is connected to who, and then based on that, do my decision. A market environment is best for my strategy is in like environments when people are starting to be a little bit greedy, like going after a correction. A lot of people are outside the markets, a lot of people are not leveraged, like there is a chunk of, of the market that is not priced in, and there are a lot of people that are just coming to the market and start buying stocks, and a lot of the times it comes with the technological revolution. And if I need to do examples, the best years probably for momentum trading, this year is an amazing year. 2025 after the tariff crash was an amazing year. You see ton of stocks going 4, 5, 6, 700, uh, going up 700 percentage very, very quickly. Periods like 2020, 2021, periods like 98, 99. Like the more, let's say, I don't want to say bubbly because I don't know, like you asked before, I don't know if you are a bubble or not, and I'm not trying to predict what is going to happen. But where we are more in a greedy environment with a lot of earnings being bought by investors, like a lot of stocks look to people like this is going to change the world entirely. These are the best environments for momentum, and this probably is not a good environment for value investing because everything is probably not everything, but a lot of the stuff are very expensive, and this is where you differentiate. Like I don't buy into market crashes. Like it's different to buy the QQQ or the S&P 500 than buying momentum stocks. It's different if you are trying to buy uh, banks for cheap or some technological company for cheap or trying to ride when there is a momentum. And the best momentum periods are when a lot of people goes crazy about the stock market. The movement are very aggressive. You see, like this environment, you see ton of stock gapping up. You see tons of stocks going up more than 10% up from their open in one day. You see tons of themes. Like in this market, we had so many themes. We had, like I said before, the memory chips and the photonics, but we had also semiconductor testing equipment and subsystem and components and AI connectivity chips. And we had materials and foundation of photonics. We had the broadband access infrastructure that went up a lot, neo cloud, precision power and timing architecture, a lot of the utility energy storage and grid stabilization. Solar starting to perking up just in the last couple of weeks. You talked about Dell, the computing system area, the AI infrastructure and high performance computing, like all those Bitcoin miners that went to be high performance computing companies, the space companies that today they're pulling back a lot, but yesterday a lot of these stocks in the last couple of weeks went up a lot. This is like maybe an episodic pivot to the downside, what is going on with space today after the explosion in, I think it's the name of the company is Blue Moon or or Origin Blue, the company of Jeff Bezos, that was an explosion, Blue Origin, that was an explosion in the rocket yesterday, and you see Planet Labs minus 12%, Voichi minus 11%, RDW minus almost 15%, STS almost 20%. We don't know what will happen. Maybe these stocks will be bought until the close today. Maybe they will be bought next week. We don't know what is going to be in the markets, but you always need to manage risk. Yeah, I think there is a big difference. First of all, I will do the definition for a gambler in what I see, and the definition of trader, and then I will compare between them. I think first of all that I don't have the statistics about gamblers in the market. I think that in a good environment, a lot of the gamblers doing great. I think if we look at this year, I think there would be a nice chunk of people that until the day we're recording it probably did a lot of money in the markets. Because if they bought the correct story stocks, they've been on a volatile stocks, a lot of them went up few 100%, and maybe these people does great. But what's differentiate between gamblers and traders is not the performance itself, but how they view markets. Gamblers a lot of the time don't understand market mechanics or study markets, but still buy individual assets based on tips, social media, or analyst reports. A lot of the time, even people come to me and I never answer that because I tell them, you never know what's going to be. I'm not a financial advisor. I don't give stock recommendations. A lot of people come asking me, what do you think about Rocket Lab? What do you think about STS? What do you think about XTI? What do you think about Micron? What do you think about the Qs? And a lot of people likes to hear from someone that they think he knows about stocks, but if he told them about the stock, they're going to buy it and not managing risk. And they went up and saw like a financial report from an analyst in a big bank, and he says like this stock is going probably to skyrocket and the revenues are going to go up and the story there is amazing. And some of these reports are probably right, but some are wrong. And the gamblers are the one that just buy based on tips, what this guy said, what this analyst said. These stocks went up a lot in the past. Now it's in a discount because it went down 70%, so they buy this stock. But they don't buy it because they really understand the mechanics of the company and they did a huge research about the market where this stock is operating. and they don't know the management, and then they buy based on tips, based on this guy said, based on the stock should go up because I have a gut feeling that it will do it, or based on this politician said it, or a friend of mine bought it, or I need to be in the markets and these stocks went down a lot or went up a lot and I will buy. And they doesn't understand market mechanics, didn't do the research. And of course, what is really important is they doesn't manage risk. And doesn't manage risk, and it comes with they don't have a game plan. Let's say you bought a stock at $100. Okay, you made a decision, and let's not talk about the research stuff, but you made a decision to buy the 100% $100 stock. It goes up to 99. What do? You do something, you don't do, you buy more, you sell part, you wait. Okay. It goes down to $90. What do? You said I was wrong, you said now it's cheaper, I will buy more. You say I'm going to research, maybe something with my thesis was wrong, I have a stop loss. What do? The stock goes back to $100. Do you sell at break even? Are you waiting for something to happen? The stock skyrockets to $120. Do you sell some? Do you buy more? What do? And a lot of people doesn't know to answer these questions. They say, well, the stock up, we will sell. And then in a good environment, that's why a lot of gamblers do good, because they bought at 100. They say, okay, I want to do minimum 150% on this stock. They just sell it, but I didn't check that the stocks they are tracking should go 150%. But they're not checking what do they do if they are wrong. Because if you put, let's say, 15% of your money on a stock and it goes down, it hurts you a lot. It can eliminate almost 50%. Let's say if it goes to zero, it eliminates 15%. But even if it goes 80% down, okay, so it eliminates almost 15% of your portfolio. And if you have a few of those companies together that goes down against you 50%. And this what differentiate traders, real traders, because a lot of traders are also in this gambling camp. Most of the people actually are in these two groups: gamblers or passive investors. Passive investors are people who buy an ETFs, an exchange traded fund, which a lot of the time has a basket of stocks. Let's speak about passive investors in the stock market.
like Warren Buffett.
On- Warren Buffett is not a passive investors. Warren Buffett is more a value investors, because Warren Buffett he do sell and buy stocks. And when I'm speaking about passive investors, I'm speaking more about people that buy the S&P 500 and sell it 40 years later. Okay, or buy the Qs. The Qs is like less passive because it's more technology, but a lot of people today buy Qs, and it's also considered to be passive. Some people say, okay, to look at the US is not enough. Okay, it's the biggest economy in the world, but it's not enough. I need to buy something like a world stocks, like to buy. I think there is the VG, I think, if I'm correct, that is the whole world. Of course, it's not. It doesn't buy the all companies in the world, but it's some part of the S&P. It buys you some in Europe, some in China, some in Japan, like the big stock markets. Uh, and most of the people are passive investors, which does better performance than most market participants. If you look at funds, if you look at people, most of the people didn't beat the S&P 500 in the last 20 years. John Bogle has a book on that, and a lot of people are passive investors because they understand the statistics. But I think the statistic comes a lot from the gamblers, because a lot of the market participants are gamblers or they are funds. And if you're a big fund, there is a limitation for what you can do. There are stocks that are too small for you to buy. There are stocks that if you will buy, you will move them. There are stocks that you can buy, but because they're not big enough, you buy a small stake. And it takes to them much more time to adjust than we, the retail traders, not only the momentum traders, can. because I can enter a lot of stocks. Let's say I'm exuberating, I'm not doing that, but 100% of my money in one stock, and I can sell it again, and I will not move the market if the stock is big enough. And a lot of these pension funds, hedge funds, they cannot do stuff like that. They manage others people's money, they move the markets, they are the ones who create the bases, they are the ones who create the expansion, the contraction. It's not the 50 momentum traders which takes a stock from $2 to $100. It's not. If a stock has a dollar volume of $5 billion a day, it's not 10 traders that moving the stock. It's the huge whales that moving the stock. And for them, they have a lot of limitations. It's not, some of them are really, really good. There are funds that beat the S&P 500s on a long horizon, but it's the minority. And also there are a lot of researchers and analysts that are really good in the institutional side, but they have limitations. They cannot do whatever they want. They're not retail investors. They have a lot of responsibility. A lot of them, for them, the S&P 500 is volatile, and a lot of the people always own bonds, which are less volatile than stocks. Uh, yeah, so I hope I gave you the difference between traders and gamblers. I hope that it is clear enough. Yes. So first of all, I will say before I dive to the names of people that um, the best teacher is the stock market itself. And what do I mean by that? Do an exercise. Take, let's say, we're now in 2026. Take from 1996. The 10 stocks, let's say, that has enough liquidity. Okay, not a penny stocks that has enough liquidity. You can choose it by yourself, okay, but you can say, let's say, stocks that has at least 100,000 shares with at least uh, $10. A $10 price on 1,000 shares is not enough. But let's say in a dollar volume that has at least a minimum $20 million average per share, and look for the 10 stocks that move the most from 1996 until this year, including this year. And then it will give you the sense of how stocks are moving. First of all, on the graph, and then you can look in which teams they were, in which areas they operated, what their financials were. Were they zero revenue stocks? Were they stocks that had a massive acceleration in earnings and sales? What was the rate of the acceleration? Which news came from? Did they have episodic pivots? Did it was stock that was IPO'd the year before or in the same year? Is the stocks went down and then went straight up? Did the stock went just straight up from the IPO? Were the stock that was causing the movement of the stocks you are tracking? How the stocks moved? Which moving averages did it respected? How was it basing? Did it base and come inside the base? Did it had a base, broke out, coming inside the base and they broke up? See the difference part of basing. Look at the overall market. Look what the S&P 500 did, or the Nasdaq 200, or both, when you're looking at the stock. Did the stock was resisting the downtrend? Did the stock has a relative strength when comparing to the indexes in the same time? I think this is like really, really important. But if we're talking about names of people and books, which I also think it is very, very important, because you want to do also the research for yourself and has the conviction yourself. But I think to have an idea how the market works, it's okay to take ideas and concepts uh, and to understand market mechanics also from other people, because the people that already did a huge research, that already was succeeding in the stock market, was doing some of the job for you with let's say some again. Okay, so if you're talking about books, I think this is like a must book, and a lot of people recommending it to read it more than one time. It is How to Make Money in Stock by William O'Neill. We spoke about it before, like this is like a five pages book that starts first of all 100 pages with a stock that moved the most from 1880 until like 2008 and something like that. And then he talks about the fundamentals, about the theme, about how the stock moved, why the stock moved, um, understanding the fund sponsorship, understanding the price structure, um, and stuff like that. And this, I think, is a very, very important book. Then you have two other books which I really like. They're from Mark Minervini, which is the USIC, US Investing Championship winner in the 1 million plus dollar accounts in the stock division. And he talks a lot about risk management, more the trading part of it. He talks a lot about the volatility contraction pattern, which is what he trades. I partially trade the two. Because of him, there is two names of books: Trade Like a Stock Market Wizards. If I remember correct, this is more like the setupy. The first one you should read, and then you have Think and Trade Like a Champion, which is more in the trading part, position sizing and understanding that you need to have a system. Also, I really like and the market series of Market Wizards interview with top traders from Jack Schwager. There is a new book of the Market Wizard series that is, I think it is available now for a pre-sale. I didn't buy it, but I think I will buy it. Um, and he had a few books. It's like an interview. It's not like how to make money in stocks or the Mark Minervini book that he speaks about a specific setup, but more like to understand the person that is behind the huge performance, what differentiates him from other people, how he acts in the market when he has struggles. And all of us are going to have struggles in the stock market. If someone thought that this is the way to earn fast and easy money, the market will humble him, trust me. The market humbles almost everyone. We hope how we evolve and grew up that the market will humble us less and will more beat the market than beaten by the market. But in the beginning, you will be humbled a lot by the market. First of all, you would think that you know how the market, is going to be the direction of the market. Then you will be correct one time and wrong 8 times, and then you understand that you do not know when the market is headed. Then it may be that you will buy a stock, you will not put a stop loss. Everyone says it should go up, it will go down against you, and then you understand that you never know for sure that the stock will go out. Another time, it can be that you thought that there is a limit to the upside of a stock, and that you bought a stock at $100 and it cannot go up after it goes to $200, and then you will see this. You are selling this stock for a 100% gain, and you will see that this stock skyrockets 1,000% gain more. Um, and it's really, really important to remember those stuff. And I think this shows you like that a lot of the market wizards and people who succeed in the market worked hard and they tried a lot. A lot of the stories, at least from what I heard, it's about people that lost their whole money a few times. Sometimes they lost the money of other people, and I think what differentiates a lot of these people from most of market participants, uh, a lot of traders, a lot of gamblers that will not succeed in the market, that although the market humbles them, and although they didn't succeed, they tried again and tried again, and they didn't try it on blind. They look at how markets work, they read more books, they did some exercise, and then they began to succeed. And I think that the strength of people to try again and again after he fell down, but not on blind, like I said, like to think what he did wrong and to do a process. I think this is what differentiate a lot from the traders, from these great traders. There is also a book that it doesn't really connect to setups. That is called the Reminiscence of a Stock Operator from Edwin Leffer. This book is from 1923. You said, what? Like, why should the things would be the same? Like, it's more than 100 years now that have been passed through that. And you read this book, and of course, there are stuff that changed. Okay, this guy went to bucket shops and was trading there, and it was different that nowadays. You almost have 24/7 trading, and everyone can open an account, and everything is so fast, and things change. But human behavior and the market mechanics have still a lot of commonalities. And you see in these periods how people come to, it's a book like about Jesse Livermore, which is a legendary trader which did a ton of money, lost a ton of money, and goes on. And a lot of people came to him, what stock do you recommend, stuff like that. And these things are probably here forever. And I think this is like a really nice view on the stuff. Secrets for Profiting in Bull and Bear Markets by Stan Weinstein. I think this is a really, really good book. This book is a little bit similar to How to Make Money in Stocks. He's less focused on the fundamentals of a stock, but he speaks about the stages of a stock. That you have stage one, when the stock consolidating. A lot of the time it's a big base, and then it goes to stage two. This is where momentum traders are operating. The stock skyrockets. You have a few bases, few continuation in price higher, and then you have stage three where the stock is basing. You have a base, but this base eventually broken to the downside. To stage four, when the stock is in a downside. Sometimes it is a fallen knife, sometimes it is a free fall, and this is how stocks move. Like a lot of the stocks you will see are in these stages. Other book that I bought it, but I need to read it. I didn't have the time, but I hope that next week I will start reading it. That I heard a lot of traders speaks really good about it. Is the Trader's Handbook: Winning Habits and Routines of Successful Traders from Trader Lion team. They're speaking a lot about setups, about building a trading system, about managing risk, about how stocks move, and I think this is like a really, really good book. This is from the book perspective, but if you want, we can also go on X accounts and websites, which I think are really, really good, YouTube channels, and I think there is something very important to understand, that it's not that you will see someone, and I think this is something that I thought a lot in the beginning, and I think a lot of people think that too. You see someone, what he's doing, and you're trying to copy it exactly. And how my father says, there's not copy paste in people. And what is good for me or what is good for you is not good for someone else. And we're not all the same, the exact thing. And I think what you should do is not copying 100% of what someone is doing, but to understand why he does that, and what you can take from him, and what is not fit for you, and what is not good to take from him sometimes. And I think it doesn't matter if it's on YouTube, on X, on other social media, on this podcast, on the books, that you should take things that feels good to you, and you can check them and to see if they are working.
I think every big trader has their own, strategy, their own trading style. That's what makes
Yeah,
them great.
yeah, that's right. You can, what Christian Kulamagi called, one of the traders, which will be on the next Market Wizard book. You can copy other people's strategies. It's okay. It's like, it's not that every soccer player or basketball player invented a move from scratch. A goal is a goal. Uh, Running fast on the ground. A lot of people run fast in soccer. A lot of people run fast or jump higher in basketball, but they do a little bit of small changes from what is already working to adjust it for them. And I think this is like really important. Like a lot of us are going to go through a degree in university. A lot of us has a common knowledge about things, but each and every one of us interpret things different, uh, think a little bit different from a lot of things. Uh, we have all of us have some friends that are similar to us, that are more similar to us than other people, but we are still not 100% the same. So it's okay to copy strategy for someone, but a lot of the time you need to build your own conviction. And if you just a lot of time just copy someone and you do not understand why you're copying it and what's going on beneath, you will not really understand when did he enter or when did he would not enter on stuff that maybe look similar to you. And the game is not that simple. If it was that simple, everyone would be rich. And although I say there is enough money in the world for every one of us, uh, how it goes between people is we feel it sometimes as not enough. Uh,
Yes, I think Warren not Warren Buffett, someone who worked with Warren Buffett said the same. No, market is not that easy like they want you to think. Everyone says the market is
yeah,
something that really easy to learn.
sometimes there are stuff in the market that looks easy. Like you will see a lot of stock and you'll say, okay, like what was the problem? You said AI earlier. It was in the AI, did something in the semiconductor industry. It sat on a bottleneck. So easy. Okay, well, it's so easy. You buy that stock. You see it was 100, went to 250. You do thousands of percentage, and it looks really, really easy. And sometimes, like I mentioned earlier, there are gamblers that do that stuff. And when the environment is really strong, without really understanding why the stock went up, they are catching those moves. But there will be the period which the market will not be good. Maybe it will be today, maybe it will be next week, maybe next month. Maybe it will take a few years until the market will be much harder than now. Nobody knows. But then they will not know how to differentiate the market environment, the understanding the market mechanics, understanding why the stock went up there. Yeah, so I think a lot of people do succeed in the market, but a lot of the time it's timely. It's not that it will stay forever, and in order it to stay, not everyone succeed forever, but to succeed in a long period of time, you need to really understand what you're doing. And I think it always in the market, it always look like it's more simple than that, than it really is. And and I think a lot you need a lot of experience and to go through a few market environments until you really understand a lot, let's say not all, but a lot of the market movements. And then you are less surprised about what's going on. It's a life experience like in everything. When you're young, you're more surprised from stuff that happens in life. And when you're older, you know what can happen more. Like we're always surprised in all the ages. But when you grew up, you more like saw stuff. You more like went through stuff, and then you're less surprised about stuff that is happening. I think it's the same with markets. It's first of all the theoretical knowledge, it then goes to your strategy, trusting your strategy, doing your exercises, entering, failing, until you succeed. Sometimes you succeed and then you fail. It happens a lot, but the better when times go on and you do more work, you should succeed more and fail less.